Hello, my name is Nick Morris, and the purpose of this presentation is to explain how to improve profitability at XYZ Credit Union. To accomplish this goal, I propose we strengthen our marketing program through data discovery and knowledge. Overall, our mortgage book of business isn't as profitable as other business segments like retail lending and commercial. Additionally, we don't have the penetration rates with mortgage like we do with our other products and services. Our full service institution provides great opportunities for cross-selling mortgages. I've broken the presentation down into three areas. First, why aren't we taking full advantage of our mortgage growth opportunities? Secondly, explain how we can turn data into knowledge that allows us to tap into our opportunities. Finally, I'd like to present several models that help us understand and predict our customer needs. This is really where we're turning knowledge into action. Part 1, pain points and opportunities. The top of the chart speaks to low loan rate trends and penetration rates for mortgages. Now this has all been during a period of unprecedented mortgage refinancing opportunities with the industry low rates. We can stimulate low loan growth by loosening credit standards just a little. As you can see, we are way above the 720 bottom parameter for A quality paper when we're talking about a Fair Isaac score. We actually increased to 771 over the past 5 years. Now the bottom of the chart speaks to aging loan portfolio and the impacts it has on our mortgage interest rates. I think everybody understands how a 360-day interest rate calculation impacts you. Just when you first get a mortgage, those first couple years are pretty tough. I mean, majority of your payment goes directly to interest, and banks and financial institutions book that directly to income and not principal reduction. I'm discussing the benefits of growing our servicing portfolios by mortgages in this slide. This pretty much comes in two parts. First, servicing requires customers to pay fees and retain deposits at our institutions for paying taxes and insurance. We earn a spread on these deposits by investing these funds in higher yielding short-term investments. Now secondly, our primary focus is to sell mortgages in the secondary market while maintaining the servicing on the loan. The secondary market provides liquidity and reduced interest rate risk, and we're not booking long-term fixed rate mortgage. We don't want to expose our credit union to excessive interest rate risk. Now we're moving into part 2, the data. I pulled together a couple of slides to show the benefits of data integration. This is really the backbone of our analysis. We can't perform data mining and predictive modeling without it. Our data warehouse provides us an incredible amount of rich and diversified data to work with, as you can see. We have details and balances for loans, investments, customer profile, and even profitability as far as providing these services. And we also have external data. Axiom is a company that gathers information. They're really data brokers, and we subscribe to that information. We associate that to our customers. You can see there's really good information here across a broad spectrum of subjects. And all this information helps us with meeting our financial needs of our customers. Make sure we're providing the right recommendations at the right time in each of our customers' lives. Now this slide speaks to the level of detail in which the data is fed into the models I've developed. It's a one row per head of household with a private banking relationship. And all loans, investments, and profitability roll up to this one row. We're looking at some aggregate amounts here. Now this is where the fun begins. We're moving into the models, part 3 of the discussion. I'm presenting two models here. The first one is clustering. In this case, we're not predicting the profitability or the probability of a mortgage loan in this model. It's all about understanding customer segments and patterns in the data. This is an excellent tool for target marketing, and it's also easily implemented. Now, the bottom of the chart, the second one, is a regression tree. Now, we are predicting the probability of an outcome, in this case, a mortgage loan. We're getting the best of both worlds here with a regression tree. A very popular method is regression with the benefits of a decision tree. That allows us to prioritize and measure our predictors as far as strength. Okay, I'm listing some of the additional strengths and weaknesses in this slide. Clustering allows us to attach a distinct customer group to our data set for further analysis. However, this modeling technique requires some interpretation and tweaking in order to optimize. Now, a regression tree is fairly easy to interpret, and you'll see a few slides, but it requires lots of training, and the impact of each variable kind of get lost within the flow. Now we're moving into the model results for clustering. This method is fairly easy to implement once the data is prepared. For the most part, I'm just using the function k-means within the R software to generate the results. I then assign labels to the cluster based on the results as provided in this example. The young affluent professional with kids. Now we can prompt our private bankers to review a possible refi or anticipate an origination with individuals within this profile. Clustering also saves time, money, and efforts by not providing recommendations that aren't well suited for customers or prospects. Another marketing approach is to augment our data analysis with credit bureau information to see if the actual individuals within this profile are a good credit risk. I mean, we really don't want to aggressively push a product that we can't approve. Now, the customer segment we just discussed is in column 2. I mean, do you notice the fairly large home value? We might actually have to watch our approach with this group so we don't end up with a high number of jumbo mortgages that we can't sell to Fannie and Freddie. Again, we're trying to sell these mortgages and retain the servicing for the financial benefits and also the cross-selling opportunities. Overall, these attributes are in order of importance as determined by the k-means algorithm. I'm only listing the top 8 out of 15, and I highlighted them in orange font if the k-means is over 0.25. This is fairly prevalent on the scale of 0 to 1. I'm seeing many other segments and marketing opportunities beyond mortgages. For example, the young female conservative savers. They're in column 3. How about shifting some saving dollars to investments, stocks, bonds, just broadening her, diversifying her portfolio. I speak to her, I'm talking about that customer segment. And be prepared for the next slide. It's a regression tree, and it looks very busy, but I'll be able to explain it. Like I said, don't be alarmed. It's fairly easy to follow. It's just like a flow chart, so let's pick a path. Remember, this model is predicting a mortgage loan with the credit union. Key note, I pruned this tree just for visualization purposes. I did away with some lower predictive axiom variables, current residence, and home mortgage value. Now the gray and green boxes depict the actual outcomes. No for no mortgage loan, and the yeses do depict a mortgage loan. Now go down to the bottom right section of the slide. We have 149 actual mortgage loans out of a predicted 253 for this path. You get a good idea of what this group looks like as you traverse up the tree to the root node. They have high household profit, and they're either young or old. If they're old, maybe they're downsizing their mortgage in their home in these cases. It's important to note that the decision nodes are in order of importance from top down. This slide evaluates the model performance. Let's discuss the upper section of the slide first. It speaks to the accuracy of the decision tree. It's important to note that our training sample built the tree while our testing sample validated it. I created a cross matrix, a confusion matrix for the purpose of identifying the true negatives, the true positives, the false negatives, and the false positives. You can see that under the template description. And the bottom portion of the slide captures the performance metrics of the validation process. I also listed the formula in the far right section of the chart. You can see how they worked and how they're derived from the confusion matrix. I bolded kappa because I think this is the most important measure. As you can see by the explanation, it adjusts accuracy, it factors in prediction due to chance. We also have sensitivity of 0.96, as you can see in the formula. It's total positive divided by total positives plus the false negatives. Pretty solid hits. That's what we're looking at. Now, prior to concluding this analysis, I ran a decision tree through a couple of ensemble-based models, random forests with and without cross-validation. I basically created a number of random samples to train and build the model with the same data set and target variables predicting a mortgage loan as we did in the decision tree. You can see a dramatic increase in kappa for random forests with cross-validation. It came out to be 0.5449. And cross-validation is sampling that you go through without repeating rows in the data set. We got a strong increase in lift here. The downfall to random forests is there is no decision tree. It's more of a black box. This slide does, however, list all the independent variables and their level of importance in predicting the dependent variables. It's a little hard to read, but this is how it shakes out. And you could see some axiom data is showing up there. And you're seeing household annual income description. You're seeing current resident length description. You're seeing profitability as a strong predictor. Other loans at the credit union are strong predictors. It just gives you a look and feel for what random forest is all about. Summary for private banking and mortgage originations. I recommend implementing the decision tree model. It's actually a regression tree for growing our servicing portfolio through origination growth, although the kappa is significantly lower than the random forest and cross-validation. It's much easier to explain and understand. Thank you. This concludes the presentation.